Hello and welcome, future intelligent investors. Today we're diving deep into a book that is nothing short of legendary in the world of finance. It's a true classic, a foundational text that has guided generations of successful investors. We're talking about The Intelligent Investor by the brilliant Benjamin Graham. First published way back in 1949, this book remains incredibly relevant today. It hasn't just stood the test of time, it has defined the very principles of sound investing. This book isn't aimed at Wall Street pros or hedge fund managers. Graham wrote it specifically for you, the average investor. His goal was to provide a clear, sensible framework for navigating the complexities of the stock market. The primary emphasis throughout the book is on a defensive investment approach. This isn't about chasing hot tips or trying to time the market. It's about building a robust, resilient portfolio. Graham's core goals are crystal clear. First, minimizing risk, and second, maximizing long-term returns. Notice the order there. Protecting your capital comes first. This is a crucial distinction from speculative approaches. The book focuses relentlessly on building a solid financial foundation. It teaches you how to think about investing as a business owner, not a gambler. It's about understanding what you own. The method Graham advocates is disciplined and informed decision-making. It requires patience, research, and a calm temperament. It's a process, not a quick fix. And let's be absolutely clear about what this book is not. It is emphatically not a guide for getting rich quick. If you're looking for speculative strategies or guaranteed overnight success, this is not the book for you. It's about building wealth steadily and securely over time. Now, let's get to the heart of Graham's philosophy: value investing. This is the central concept that permeates every chapter of The Intelligent Investor. It's a powerful idea that has been adopted and championed by some of the world's most successful investors, including Warren Buffett. So, what exactly is value investing? At its core, it's the strategy of identifying undervalued securities. These are stocks or other assets that the market is currently pricing below their true worth, their intrinsic value. The action you take as a value investor is straightforward. You purchase stocks that are trading below their estimated intrinsic value. You're essentially looking for bargains in the stock market. You buy a dollar's worth of assets for 50 cents. A key principle that Graham introduces, and perhaps his most important contribution, is the margin of safety. This concept is absolutely fundamental to protecting your capital. It's your primary defense against uncertainty. The margin of safety is defined as the difference between the market price of a security and your conservative estimate of its intrinsic value. You want this difference to be substantial. You want a cushion. The purpose of this margin of safety is twofold. First, it protects you from potential errors in judgment. Let's face it, nobody's perfect at estimating value. A margin of safety gives you room for error. Second, and equally important, it protects you from market volatility. Stock prices can swing wildly based on emotion and short-term news. Buying with a margin of safety means you're less exposed to these irrational fluctuations. To implement value investing effectively, an essential tool is fundamental analysis. This is the process of examining the underlying health and prospects of a company. You're looking beyond the stock price to the actual business. Fundamental analysis focuses on examining a company's financial statements. These documents provide a wealth of information about how the business is performing. They are the language of business. Key financial statements you'll analyze include the balance sheet. This statement shows a company's assets, liabilities, and equity at a specific point in time. It's a snapshot of its financial position. Another critical statement is the income statement. This shows a company's revenues, expenses, and profits over a period of time. It tells you how profitable the business is. And don't forget the cash flow statement. This tracks the movement of cash into and out of the company. It shows you where the money is really going. The purpose of this detailed analysis is clear: assessing the company's financial health. Is it stable? Is it growing? Can it meet its obligations? You also analyze these statements to assess the company's future prospects. Based on its current performance and financial structure, what are the chances of continued success and growth? This analysis informs your estimate of intrinsic value. Graham makes a crucial distinction between two main types of investors: Understanding which type you are is vital for choosing the right strategy. He differentiates between the defensive investor and the enterprising investor. Let's look at the defensive investor profile first. This investor typically has limited time and resources to dedicate to investing. They might have a full-time job or other commitments that prevent deep dives into company analysis. They prioritize safety and simplicity. The defensive investor strategy is characterized by a passive, diversified approach. They aren't actively trading or trying to outperform the market through complex maneuvers. They build a solid, broad portfolio. A typical portfolio for a defensive investor might include high-quality, dividend-paying stocks and bonds. These are generally stable companies with a history of returning value to shareholders. Diversification across different industries and asset classes is key. The primary method for the defensive investor is a buying and holding strategy. Once they've built their diversified portfolio of quality assets, they hold onto them for the long term, reinvesting dividends and riding out market fluctuations. This requires patience and discipline. Now, let's consider the enterprising investor. This type of investor is willing and able to devote more time and effort to their investments. They are more proactive in seeking out opportunities. The enterprising investor strategy involves a more active approach. They are willing to look for special situations or undervalued securities that might require more in-depth research and analysis than the defensive approach. This might involve investing in less popular or overlooked companies. It could mean exploring opportunities in areas that require more specialized knowledge. It demands more skill and effort. However, Graham warns that the enterprising investor must still adhere to value principles. This is not an invitation to speculate wildly. It requires rigorous analysis and a margin of safety, just like the defensive approach. The key difference lies in the type of opportunities pursued and the amount of effort applied. The enterprising investor is looking for situations where their extra work can uncover value that the market has missed. Graham also dedicates significant space to discussing bonds and preferred stocks. While stocks often get the most attention, bonds play a crucial role, especially for defensive investors seeking stability and income. He explains how to evaluate the safety and yield of different types of bonds. Understanding credit ratings and interest rate risk is essential for incorporating bonds into a portfolio effectively. Preferred stocks are also discussed as a hybrid security, offering features of both stocks and bonds. Graham provides guidance on when and how these might fit into an investor's portfolio, again emphasizing safety and value. A major theme throughout the book is the importance of investor psychology. Graham introduces the famous allegory of Mr. Market. Imagine you own a share in a business, and you have a partner named Mr. Market. Every day, Mr. Market shows up and offers to buy your share or sell you his. Sometimes he's euphoric and offers a very high price. Other times he's depressed and offers a very low price. He's manic-depressive. Graham's point is that the intelligent investor should not be dictated by Mr. Market's moods. You should use his offers only when they serve your interests. You buy when he's depressed and selling cheap, and you might sell when he's euphoric and buying high. You should never feel compelled to trade just because Mr. Market shows up. Your decision to buy or sell should be based on your analysis of the underlying business's value, not Mr. Market's irrational emotions. This is a powerful lesson in emotional discipline. Graham also provides specific guidance on portfolio policy. He suggests a simple framework for allocating assets between stocks and bonds. This allocation should be based on the investor's risk tolerance and financial situation. For most investors, he recommends a range perhaps between 25% and 75% in stocks, with the remainder in bonds. This allocation should be adjusted over time, potentially becoming more conservative as retirement approaches. Rebalancing the portfolio periodically is also crucial. If stocks have performed well and now represent a larger percentage than your target allocation, you sell some stocks and buy bonds to bring it back into balance. This forces you to sell high and buy low. Graham also discusses the importance of dividends. For defensive investors, dividend-paying stocks provide income and can be a sign of a stable, profitable company. Reinvesting dividends can significantly boost long-term returns through compounding. He advises investors to be wary of companies that pay out an unsustainably high percentage of their earnings as dividends. A healthy dividend is one that the company can comfortably afford to pay and grow over time. Another key section of the book deals with security analysis techniques. While the book isn't a deep dive into every analytical tool, Graham provides the fundamental principles for evaluating a company. He emphasizes looking at earnings power, dividend records, financial strength, balance sheet health, and management quality. These are the core factors that contribute to a company's intrinsic value. Graham also discusses specific examples and case studies to illustrate his points. He analyzes real companies from his time, showing how his principles could be applied in practice. While the companies have changed, the principles remain timeless. He provides criteria for selecting common stocks for the defensive investor. These criteria often include things like adequate size of the enterprise, a sufficiently strong financial condition, a history of continuous dividend payments, and a history of stable earnings.